Every day at exactly 3 p.m. and 10 p.m., a specific market behavior repeats itself. If you can spot this, you can profit consistently, no matter how busy, tired, or newbie you are. This was me years ago, hustling several part-time jobs, school, or both, all while trying to learn how to trade and becoming profitable. By the end of the workday, I was dead tired. I didn't even want to open my charts, much less actually trade. I desperately needed a solution to generate consistent profits extremely predictably while working around the time constraints of my schedule. I literally did hundreds of hours of backtesting and thousands of dollars lost in funds. But I finally cracked the code, and these are my numbers. So in this video, I'm going to give you a full step-by-step breakdown on my mechanical trading strategy that allowed me to profit even as a busy person. Now, this video is structured for all levels of traders. At the start, it's going to be beginner friendly. But as it goes along, it's going to get more and more advanced. So trust me when I say that no matter what trading strategy or what level you're at in trading, you will gain something from this video. To prove it to you, at the end of this video, I left a nugget that will skyrocket your win rate if you stay all the way to the end of the video. Now, if you don't already know who I am, my name is Nick and I'm a multi-7-figure trader. And here are my most recent withdrawals as proof. I've been in your shoes before, so I know exactly how you feel. In this video, I will show you a trading strategy which aligns time and price so you can set your own working hours for your trading day. Here's what you'll gain by the end of this video. Number 1, power of 3 concept, which includes accumulation, manipulation, and distribution. Number 2, how to set your own working hours. And lastly, number 3, the mechanical trading strategy. Yes, this includes where to enter, SL and TP, all the trade management levels that you need to know for this strategy. This mechanical trading strategy only relies on a few specific candlesticks. We're looking for exact candlestick patterns at an exact time to execute winning trades based on swing highs and swing lows. That means if you open your trading app right now and you see this candlestick pattern form during your time frame, you can confidently trade and win. But if you open the trading app and the candlestick pattern that you want to see doesn't form, then close the trading app and go about your day. It's that simple. So without further ado, let's get right into the strategy. Most people think they know what a candlestick is, but I'm going to explain it in a way which actually makes you money. A candlestick shows the market's open, high, low, and close prices for a specific time period. For example, a daily candlestick shows the market's price for the day. The body represents the difference between the open and the close, while the wicks shows the high and the low. If the candle is green, then the price closes higher than it opened. If it's red, price closes lower. It's a quick snapshot of price movement. Now, how does this relate to the core piece of the strategy, the power of 3? Power of 3 involves 3 main market movements: accumulation, manipulation, and distribution, or AMD for short. I know it sounds complicated and nerdy, but let me break it down to simple human language for you. Accumulation. This is where the market seems quiet, but big players are secretly building their positions. Think about it like a slingshot, slowly recoiling back, and at any one moment, boom, we get a huge impulse move. It looks something like this when the candlesticks are ranging about, not creating big up or down candles. Manipulation. An impulse move opposite to the market direction that shakes out the weak hands. These are wicks on candles that essentially stop loss hunt traders and liquidate them for our benefit. So it looks something like this, where this candle wicks up or down. Distribution. A significant move in the direction where banks and institutions want the market to go. The candle will look something like this. So the 3 moves are A for accumulation, M for manipulation, and D for distribution. AMD. Easy enough? Now let's link the power of 3 to what we already know. Singular candlesticks. The power of 3 has 3 cycles: accumulation,
manipulation, and distribution. So we will look for 3 candles at specific times, with each candle representing a respective PO3 cycle. Look for an accumulation, a manipulation candle, and then a distribution candle. Quite simply, a 3 candlestick move. To see this AMD cycle in 3 candlesticks, we need to understand a swing formation. It is just a formation of a swing high or low point that involves 3 candles. For example, if we're looking for a swing high point, it should look something like this. Candle 1 creates a reference point. Candle 2 sets the high and wicks out the stop losses. Then candle 3 moves lower. Now this is a swing high. For a swing low, candle 1 again creates a reference point right over here. Candle 2 sets the low. Then candle 3 moves higher. These 3 higher time frame candles give you an overall market structure. And this is how they look like on the lower time frames. You have candle 1, which sets the reference point or the accumulation. Candle 2 takes out the high of the candle 1, manipulating this high. Candle 3 finishing off the move, distributing lower. Candle 1, 2, 3. AMD. Very, very simple stuff. Now you understand what candlestick pattern to watch out for. I'm going to give you the secret sauce. What exact timings to the second to trade these patterns on, and how you can profit from them. Here is how you can set your own working hours for the strategy. There is London session and the New York session trading opportunities for you to be able to capitalize on. Pay attention to these timings in the GMT plus 8 time zone, right? GMT plus 8. Our London time is from 2 to 4 p.m. and our New York time is from 8 to 10 p.m. We literally do not care about price outside of these timings. And that's the beauty of the strategy. You can set your own working hours for 2 hours per day within these 2 time windows. And then you're done for the day. Candle 1 will be the 2 p.m. and 8 p.m.'s 1 hour candle. That means you go to TradingView, you click the H1 time frame button, and you look for this candle here. This is going to be the price range we play in. We are either looking for the high or the low of candle 1 to be swept, and then a distribution to the other side of the range. So if candle 1's high has swept, we are going to be looking for price to distribute to its low. If candle 1's low is swept, we are going to be looking for price to distribute to its high. Let's go over a few key rules of this strategy. Now, if you do not follow these rules, this strategy immediately fails. So pay very close attention. You never want to trade the 2 p.m. or the 8 p.m. candle. This is because we want these candles to be swept, giving us a proper price range to trade within. You can trade the 3 p.m. and the 9 p.m. candle. You also can trade the 4 p.m. and the 10 p.m. candle. If you're looking to trade after that, it is still possible as long as the targets are still intact. Got it? Now, let's run through the strategy itself. There are 2 different entry types: second candle entries and third candle entries. The second candle entry simply means that you're entering on the 3 p.m. or the 9 p.m. hourly candle. The third candle entries refer to entries at the 4 p.m. or the 10 p.m. hourly candle. Let's talk about the second candle entries first. Step 1. On the hourly time frame, after the 2 p.m. or 8 p.m. candle close, use a fit retracement tool to mark out the high, the low, and the 50% level of candle 1. Step 2. Drop down to the 3-minute or 5-minute time frame to observe the high or the low of candle 1 being swept. This means that there should be a body candle close above or below the marked out high or low of that candle. Step 3. Once the high or low of the candle 1 has been taken out with a body candle close, you want to look for a change of character, overlapping with a fair value gap. I'll go through what a change of character and fair value gap is right now. A change of character is a reversal pattern that forms when there is a trend change. Now, in an uptrend, you want to see a break of the most recently created high low for you to consider it a bearish change of character. With reference to this drawing, the most recent high low is here. And once price breaks below it, a bearish change of character forms. For a downtrend, it is the opposite. You want to see a break above the most recent lower high right over here to consider it a bullish change of character. Now, for fair value gaps, it is a 3 candlestick pattern that can be identified between the gap of the first candle's wicks and the third candle's wicks. Now, as long as the wicks of the first candle and the third candle do not overlap, do not touch, a fair value gap is formed. Now, the direction of which the fair value gap is formed is determined by the second candle. So that means if the second candle is a bullish candle, that means that the bullish fair value gap will form. Vice versa for the bearish fair value gap. Let's move on to step 4. Enter at the retest of the change of character level with stop loss placed at the most recent swing high or low, targeting the opposing range of candle 1. For trade management, once price hits the 50% level of candle 1, move your stop loss to break even and take partials on your position. I know, it may seem confusing. So let's dive right into some examples on the charts and show you how to execute the second candle entries. For our first example over here, we have the New York trade opportunity. This is the hourly chart on the Euro US dollar. The 8 p.m. candle has just closed. So let's mark out our highs, lows, and the midpoint with the fit retracement tool. This is step 1 done. Step 2, let's drop down to our 3-minute time frame. What we can see here is that we see the high that has been set at 8 p.m. This has been swept. So let's wait for our 3-minute change of character that overlaps with a fair value gap. And as you can see, price created that right over here. Now, if you still don't know what a change of character or a chokchi is, it is a shift in the market structure that indicates a potential reversal or a change in trend, marked by the price breaking through key structural highs or lows. Let's place a sell limit at the change of character level here, with stop loss at the most recent swing high, with take profit at the low of the 8 p.m. candle. Now, the reason the stop loss is placed as such is because the swing high is the previous higher high point before we shifted market structure or created a change of character, meaning that this high here is protected. Now, let's see how this trade plays out. As you can see, we've hit the 50% level of the candle, and therefore we will shift our stop loss to break even and take partials. Let's see how the remaining of the trade goes. Price eventually takes us out at break even after securing our partials, but we would have smashed full take profit. There will be cases like this, but I will address it after all the examples so you can refine your trading strategy based on your personal risk parameters. Next, let's look at the London trade opportunity. Again, we are on the hourly chart on Euro US dollar. The 2 p.m. candle has just closed, so let's mark out our highs, lows, and midpoint with the fit retracement tool. Step 2. Let's drop down to our 3-minute time frame, and we see that the high of the 2 p.m. candle has just been taken out. So let's wait for our 3-minute change of character and our fair value gap. The change of character is when this higher low is broken through right over here, and the fair value gap is marked out over here. Again, we will set a sell limit at the change of character level with stop loss at the most recent swing high, with take profits at the low of the 3 p.m. candle. Alright, so let's see how this trade plays out. Once again, we have now hit the 50% of the candle. So we will shift our stop loss to break even and take partials and let the trade continue running. And now, there we have it. Full TP smashed. Pretty simple stuff, yeah? Let's move on to the third candle entry now. It's going to have slightly more steps involved and is definitely more advanced, so pay very close attention. Third candle entries are still valid as long as the opposing range of candle 1 is not taken. That basically means that if candle 2 does not break above or below candle 1, you can take the third candle entries. Okay, so let's go through the step all over again, and this time with more details. Step 1 is the exact same. We are still going to use the Fib tool to mark out our reference candles high, low, and midpoint. Go to the 1 hour time frame. Then this is how it's done on the TradingView settings. Step 2, wait for candle 2 to close. As long as we haven't taken out the high or low of candle 1, we can still use candle 3 for a continuation trade. Step 3, mark out the open price of candle 3. If you are looking for sells, we want to sell above candle 3's open. If you are looking for buys, we want to buy below candle 3's open. That means if candle 3 opens here, we are only looking for sells right over here. If candle 3 opens here, we are looking for buys over here. This is extremely important to note because this is the key difference between candle 2 and candle 3 entries. Step 4. Wait for price to fill some sort of fair value gap or sweep liquidity above or below candle 3's opening price on the 3 or the 5 minute time frame. Step 5. Enter at the fair value gap or liquidity sweep with stop loss placed at the swing point, targeting candle 1's opposing range. Now, if you're not sure what liquidity sweeps are, it happens when price briefly moves above or below a key level to trigger stop losses or gather orders. This creates a quick spike in price and often leads to a reversal or continuation of a trend. Again, I know this may sound like a whole bunch of gibberish, so let me show you actual examples of this trading strategy. Here we are on the 1 hour chart on GBP US dollar. Step 1. Let's mark out our reference candles high, low, and midpoint with this Fib tool right over here. Step 2. Candle 2 has closed at 10 PM. You can see that the target has not been reached yet right over here. Step 3. Let's drop down to the 5 minute time frame and mark out the 10 PM open. We can see that we have a 5 minute bearish fair value gap above candle 3's opening price here. So let's pay close attention to this area. Great. Now that we have tapped into the fair value gap, let's enter for sells. This is a good position to enter for sells because the market will look to rebalance these inefficiencies or gaps, collecting pending orders or liquidity to push price further into its intended direction. Our stop loss is at the most recent swing high and take profit is at the low of candle 1. The reason we put our stop loss there is because the high is protected due to the change of character that happened in the first place right over here. For take profit wise, we want to maximize our full reference candles reach, and therefore we target this candle's low. Now, our risk to reward ratio here is a 1:1.64. Now, if you want to follow this strategy mechanically, just stick to the rules as follows. But if you want to stretch your RR just a little bit more, max out at a 1:2 risk to reward ratio if it's beyond your candle 1's target. Now let's see how this trade plays out. There we go. TP smashed. With that, let's move on to our next example. We are on the 1 hour chart on USD JPY. Now, I hate sounding like a nagging mother, but I really want to make sure that you are familiar with the steps of this strategy. Alright, so step 1. Let's mark out our reference candles high, low, and midpoint with the Fib tool. This is done on the 1 hour time frame. Step 2. Candle 2 has closed at 4 PM. You can still see that the target for both the high and the low hasn't been reached yet. That means we can look for candle 3 entries. Step 3. Let's drop down to the 5 minute time frame and mark out the 4 PM open. We can see that we have a 5 minute fair value gap above candle 3's opening price. Let's wait for price to tap into this area. There we go. Now we have a tap into the fair value gap. Let's enter for sells right now with stop loss above the most recent swing high, targeting the low of candle 1. We entered here because price is retraced into the fair value gap, indicating a potential reversal point where pending sell orders are present. Our stop loss is placed there since this high is still protected from the initial change of character created. Take profit is placed here because price becomes unpredictable at candles 1's low. So we want to take profits there to avoid any risk of the trade potentially reversing. And let's see. Boom! Easy profits done. There we have it. A simple mechanical strategy that will help you create your own working hours. Since you have stayed this long, I want to give you a bonus tip that will help you increase your win rate even further with this strategy. To do this, you need to be familiar with liquidity concepts and fair value gaps. I have videos covering these topics extensively. This time-based strategy becomes even better when you pair it with 4-hour or 1-hour fair value gaps. Let me show you. We have a 1-hour bullish fair value gap here, perfectly aligning with our London trade opportunity. This means that we have more confluences to expand higher. Do you see how much faster we managed to expand and with so much more energy than the previous examples that I've shown you earlier on? Stacking confluence like this can definitely help you increase your win rate. Take note of more scenarios like this in your backtesting. It will definitely help you out. Now, that's not to say that this strategy has zero downside. With every single setup and trading plan, there are certain pitfalls that can and should be avoided where possible. Here's what I found from my extensive backtesting. Number 1, trading non-volatile instruments. This is probably the biggest pointer of them all. You need to be trading currency pairs with enough volatility throughout the entire day. Things like Euro US dollar, the pound US dollar, and gold. These pairs here that I've just mentioned are all great examples of highly volatile pairs. Non-volatile pairs are like more exotic pairs like your AUD CHF, AUD NZD, CAD CHF, or other instruments similar to those. The lower time frame for these pairs tend to be way more choppy, and you may get caught up in the choppy price action that could potentially stop you out of your trade before heading to your direction more often than not. So, what you want to do here is avoid these choppy pairs at all costs. Number 2, rushing the confirmation. I get it. You're excited to hop into a trade, but don't just rush into the trade without seeing the confirmations. Oftentimes, new traders love to hop into these trades without seeing proper change of characters, proper displacements, and set ridiculously tight or potentially even huge stop losses. Now, make sure that you guys here practice patience and not rush into a low probability trade. And trust me, it will pay off. Lastly, number 3, trading the second candle. I know, it's one of the entry models I mentioned earlier on. But hear me out. There's a level of subjectivity to be had when trading every single strategy. I would argue that trading the second candle is more difficult than the subsequent candles because you're essentially trying to call the absolute top or absolute bottom of the local market trend. That is extremely difficult to do if you're just starting out and unfamiliar with most concepts. So therefore, I would highly recommend you taking the third candle entries only. It can save you from a ton of unnecessary losses. Second candle entries are for advanced traders that understand the nuances for each pair. For example, I specifically trade GBP JPY and XAU US dollar on stream because I have a very deep understanding of exactly how each pairs move, which is why I have a historical 87% win rate on these pairs.
As we wrap up this strategy, let's touch on a few important aspects to enhance your trading approach with this specific strategy and beyond. First, a risk management process must always be incorporated. I don't care what strategy you'll be trading, right? Be it this one or the thousands of other strategies available online. You must have your risk management in check to be successful in this game for the long term. This means having specific and clear stop loss criteria, determining position sizes based on your risk tolerance, and ensuring that your risk overall exposure is manageable for you personally. With this strategy, I personally risk anywhere from 1 to 3% of my account because the opportunities are present almost every single day. I want to be able to minimize my risk exposure in the markets and not risk on the higher end like I do with my bread and butter approach on stream. Next, consider backtesting this and other strategies you like to use to see how it performs under various market conditions. The markets change almost every single day. And if you want to be as prepared as possible for the ever-changing market conditions that you're going to be presented with, this will give you the confidence in your approach to help you refine your entries and your exits. Lastly, if you are a day trader, you will know that timing is absolutely key to catch large move in trading without getting preemptively wigged out of the market just by a random spike. You can incorporate the time window discussed in this strategy to see how you can apply other institutional strategies with this time window to yield more optimal trading results. If this video has enlightened you in any way, shape or form, make sure to smash the thumbs up button. Now, I live stream every single day on YouTube, so make sure to subscribe to get alerted when I hop onto a live stream every London and New York session. Do click the first link down in the description below to join our Telegram channel where we send 5 analysis every single day to ensure that you guys here can catch the same trades that I am personally looking for. Now, with that being said, rewatch, internalize, and backtest this strategy for yourselves, and I'll see you guys in the very next video. Nick signing out.